Good morning and a very warm welcome to the session on regulatory measures towards consumer credit and bank credit to NBFCs. I am Neelam Jha, ex-Chief Manager, Faculty, Central Bank of India. The rise in unsecured loan books of certain regulated entities have been on RBI's radar for quite some time. For example, the growth in credit card customer base on YOY basis is around 20%, but the outstandings have risen by more than 29%. Similarly, the personal loan growth has been 25.5% on YOY basis for the first half of financial year ending March 24. There are early signs that the rapid growth in disbursements to unsecured personal loans may result in stressed portfolios and higher NPAs. Further, the delinquency numbers for unsecured loans below Rs 50,000 has already crossed the 5% marks. Against these numbers, let's look at the recent regulatory measures announced by Reserve Bank of India towards consumer credit and bank credit to non-banking financial companies, wherein the risk weights have been increased by an additional 25 percentage points for outstanding as well as new consumer credit exposure with immediate effect in the following areas. But please note that the new regulations will not be applicable to housing loans, educational loans, vehicle loans and gold loans. So in these four areas, these new regulations will not apply. At point number 1, we begin with the consumer credit exposure of commercial banks. As per extant instructions applicable to commercial banks, personal loans attract a risk weight of 100%, which has now been raised to 125%. At point number 2 comes consumer credit exposure of NBFCs. Previously, NBFCs' loan exposures generally attracted a risk weight of 100%. But now, the consumer credit exposure of NBFCs categorized as retail loans, excluding housing loans, educational loans, vehicle loans, loan against gold and jewelry, and microfinance and self-help group loans shall attract a risk weight of 125%. At point number 3, let's take up the credit card receivables. Earlier, the credit card receivables of scheduled commercial banks attracted a risk weight of 125%, while that of NBFCs attracted a risk weight of 100%. But now, the risk weights on such exposures have been increased by 25 percentage points to 150% and 125% for scheduled commercial banks and NBFCs respectively. And at point number 4 is the guidelines regarding bank credit to NBFCs. In terms of extant norms, exposures of scheduled commercial banks to NBFCs, excluding the core investment companies, they are risk weighted as per the ratings assigned by accredited external credit assessment institutions. But now, the risk weights on such exposures of scheduled commercial banks has been increased by 25 percentage points over and above the risk weight associated with the given external rating in all cases where the extant risk weight as per the external rating of NBFCs is below 100%. This point has to be noted very carefully. Further, in this case, loans to housing finance companies and loans to NBFCs which are eligible for classification as priority sector in terms of the extant instructions shall be excluded. And yes, all top-up loans extended by regulated entities against movable assets which are inherently depreciating in nature, such as vehicles, shall be treated as unsecured loans for credit appraisal, prudential limits and exposure purposes. Further, for strengthening the credit standards, the RBI has asked the regulated entities to review their extant sectoral exposure limits for consumer credit. These limits shall be strictly adhered to and monitored on an ongoing basis by the respective risk management committees of the banks. All regulated entities shall endeavour to comply with this provision at the earliest, but in any case shall implement them by not later than February 29, 2024 as per RBI instructions. The central focus of these instructions is to mandate banks and NBFCs to allocate more capital against unsecured consumer credit. See, the banks and NBFCs, they need to strengthen their internal surveillance mechanisms and address the elephant in the room, which in this case is build-up of risks. And hence, suitable safeguards need to be instituted in the banks as well as consumers' interest. To sum up, I would say these regulatory changes aim to strike a balance between fostering consumer credit growth on one hand and preventing the build-up of systemic risks on the other. Thank you all. This was about this session, and see you all in the next session.